Hello everyone, this is Andrew McNair from SWAN Capital with our February 2022 SWAN Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets, but I want to provide you some perspective on what these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, at SWAN Capital, our market outlook remains cautious, and here's why. We're keeping a close eye on inflation as well as the possible interest rate hikes that may go along with this high inflation period we're in. Now, the market is coming back after its worst month since March of 2020. Now, before jumping back to early February, we have to unpack this month. During the early part of this month, we ripped upward on the back of a strong fourth quarter GDP report, or gross domestic product reading, while blowout earnings from Apple and Google kept the markets chugging along. Now, the market played this game of cherry-picking company earnings while ignoring weak economic data, the Ukraine-Russia tensions that are happening, as well as the potential impact on energy prices, even as oil surpassed $90 per barrel. But that didn't matter. The market cherry-picked various companies' earnings and focused on the good news. Now, the Federal Reserve is still on track to raise interest rates in March, and the U.S. 10-year Treasury yield has crossed over 1.9%. The ADP jobs number showed a net loss in jobs in January, and the JOLTS report, or the Job Openings and Labor Turnover Survey, showed nearly 11 million job openings. But then we had disappointing news earnings coming from Meta and PayPal. So that's Facebook and PayPal, which showed just how fragile this market can be when companies can drop over 25% in one day. Now that week, the markets instead fixated on stellar revenues from Amazon to push it higher. And we also had a strong BLS report, or the Bureau of Labor Statistics report. And it really solidified that a move in March from the Fed is definitely probably going to happen. And the good news for this month is labor market results. After a big commotion over the fourth quarter GDP increase of almost 7%, the grim reality of a slowing economy has resumed. But is the economy really slowing? That's the question. Not if you look at the jobs report this month, which we want to spend a lot of time talking about, because the ADP number showed a net loss of 300,000 jobs, while the consensus expectations for Friday's BLS non-farm payrolls called for a gain of only 150,000. So there was a lot of hand wrangling as all kinds of reasons were given in advance for a weak number on top of an already weak number in December. But the actual number was an eye-popping 460,000 jobs. In addition to the unemployment rate inching up to 4%, while the December and November jobs numbers were dramatically revised. So if we're looking at just job growth, we also need to keep in mind wage growth. And wages also climbed 5.7% year over year. But that still trails the rate of inflation. Wages should be increasing along pace inflation. Now, the BLS reported changes in their benchmarks for the revisions, but you have to wonder, how could they be so off with this report? So whatever the case, it appears that if you want a job, you can get one. And there's simply not enough workers available, so wage pressure will continue. Since unemployment has settled in at that 4% range, we're pretty much at full employment. You can really never be at zero employment because people move in and out of jobs, and this is known as structural unemployment. And it averages typically around 3%. So structural unemployment can happen for many reasons, such as the inability to afford or the decision not to pursue college or further education or additional job training, or choosing a field of study that may not produce as marketable job skills, or the inability to relocate. Maybe you want to stay in your own city. That being said, it looks as if we're close to full employment. So the only thing likely left for the Fed to do at this point is to focus on inflation. So with the inflation rate running at 7% and wage inflation becoming a bigger deal, the Fed may have to act more aggressively than what markets are anticipating right now. So the challenge is trying to determine how many times will the Fed increase rates and to what extent will they increase rates. There has been no indication that it's the expected increase on the Fed funds rate until March, and no further guidance has come from the Fed. Now, while the jobs data has just told us that we're fully employed and wages are going up, both of these are apparent signals that the Fed will be increasing interest rates in March. Now, there was a consensus that we would see the end of quantitative easing, basically the loosening of money. We're going to stop and slow that down as the expansion continues. So the Fed meeting left us with the details that the bond purchases for quantitative easing were lowered to $30 billion per month, and a likely rate hike would take place in March. So although the Fed made no real commitment on that front, Fed Chair Jerome Powell also confided that inflation should have been worse and the supply chain won't get fixed for a year. So we need to keep a close eye on interest rates, because as interest rates go up, it makes the stock market less enthusiastic for investors to seek after, because they can find a reserve in the bonds that still give them the interest rate maybe they want, but with less risk. So I want to thank you for listening every month to our SWAN Report, and we look forward to seeing you next month for our March 2022 SWAN Report. See you next month.